Well, I decided to take Easter Sunday off. It was my first off day, I think, since the day after Christmas. And that wasn't too bad since there wasn't really much going on yesterday, and frankly, on a holiday, I'm not in the mood to talk about whatever terrible news is going on, even if I can drum some up. But today we're back to business. Financial markets are open again. Of course, they were closed on Good Friday. Wall Street always loves to take a 3-day weekend, when it comes to any holiday. Not just because of Good Friday, but Good Friday is a pretty decent excuse to take the day off. So today I got up and decided to read the news like I usually do. I check places like Zero Hedge and antiwar.com, although lately with all the domestic stuff that's been going on, I haven't had as much time to get to antiwar.com, so you might have noticed there's been, in the last couple months, very little foreign policy discussed on this channel. And that's because I've really been craving all of this economic excitement that's been going on, all this action, not just in financial markets, but in the broader economy, and trying to square the circle between the two. I mean, that was really the main reason why I started this channel, was because I thought there were far too many economic illiterates on the internet. And I have to say, it's a combination of emotions between sort of a see I told you so kind of vindication, and also a massive blackpilling when you look at just how dominant the mainstream view is, or I should say the character of the mainstream view. I would like it that if obviously not me, since I have absolutely no impact on any sort of discussion, but other people like me had a little bit more influence, because since every time it is folks of the Austrian persuasion who so well, outline beforehand why a crisis is going to occur. And I feel like in 2008 and now, those of us who have been calling out the excesses in financial markets and the massive credit bubble that we've all been sitting on for the last few years, receive some vindication but absolutely no credit. And I don't mean credit to individuals. I care less about that. If people like me or Peter Schiff or the folks at the Mises Institute or anyone else who is actually, pushing out, day to day and applying the theories which demonstrate why we were in such a massive bubble that is now in the process of bursting, even though we are, currently still in a rally, and I'll get to, the day-to-day market stuff here in a minute. But what really pains me is that the theories are never given credit. Our economic ideas that we so strongly believe in, because they've been proven true over and over again, because logically they are what explains the reality we live in, those never receive any credit. After these crises, nobody ever has a mea culpa. They never realize that they were wrong. They just double down on their beliefs, and they say, oh, well, that was a one-time thing. Nobody ever could have predicted that. That's in the past. And now it's happening yet again. And the reason why I have this whole, 3.5-minute buildup is because today I woke up to a rather black-pilling headline from Goldman Sachs, the folks who in January absolutely did not predict any kind of recession or depression or any kind of bear market in the stocks. They now, in April, are calling the bottom. Now, I have no idea why we're supposed to believe people who had absolutely no idea that there was any possibility of a crash coming anywhere time in the near future, now saying that, okay, no, we see where this is going, and it's all up from here, guys. But then when I actually clicked on the article and read their reasoning behind it, it was actually kind of encouraging. But also it was rather disgusting. Goldman's justification for changing their call, which had originally, up until now been pretty bearish throughout this whole rally, the reason why they just changed their call was because of the unprecedented actions by the Fed. And Goldman essentially looked at everything the Fed's doing now, buying corporate bond ETFs and buying junk bond ETFs, and seeing how this is directly meant to help prop up financial markets. And they said, well, if that's the case, then the Fed is essentially coming as close as they can to targeting the price of stocks from a policy standpoint, as they can, without actually buying stocks. And so therefore, say whatever you want about the real economy, but the price of stocks is going to go, it has nowhere to go but up. And this is a very interesting case. It's the kind of case that you wouldn't expect from a super mainstream voice, although when we're in this time of crisis, perhaps it is actually serving to wake some people up. Now, of course, you're not going to have folks at Goldman Sachs, reading Hayek's monetary theory of the trade cycle or, Mises's theory of money and credit, but they are at least accepting the very fundamental notion that central bank policy exists to inflate asset prices, and that there is no fundamental support for this. That they're not forecasting that we've got a bottom in the market because the economy is going to go through the moon from here, and because we're going to recover and do so well, and therefore it's now the time to buy up the stocks of these companies because they're going to go up in value as our economy reopens. No, what Goldman is saying is that the Fed is going to inflate the price of these assets. And so therefore, it's a good time to buy so that you can take advantage of that. Essentially, it will be like a way of holding out a bucket and catching all this money that the Fed is rolling off of its printer. Now, I don't think that these folks have the level of introspection necessary to realize that that the fortunes they've made over the last 10 years since the 2008 crisis, and even before that, were essentially, this same strategy. It's not that any of these folks are good at picking stocks or bonds or anything like that, and of reading balance sheets and realizing which companies have the most potential or whatever, and what is a good buy and what is a bad buy. Frankly, in our Fed-controlled quote unquote market, if you just have a monkey throwing darts at a board, he's going to pick a winner. And so what Goldman is saying here is they're essentially repeating the old slogan, "Don't fight the Fed." And I have to say, I don't entirely disagree. I still think it's way too risky for me to put my money, where their mouth is. I don't think it's at all guaranteed that the Fed will be successful in propping up asset prices, as they plan to do. However, the intention of the Fed's actions, are pretty clear. But for me, the one thing that stands out is the fact that the Fed has not yet started buying up actual stocks. They're still nibbling around the edges. They're buying up the debt of companies that are publicly traded, which of course, helps those companies out, and so therefore should attract people to their stocks. It would make their stock more desirable. However, they haven't taken the step of buying up stocks directly. So what that means is that there needs to be, one more real downside shock to get the Fed, over that lump. The Fed is still waiting for there to be some, another big crash before they whip out, their last ditch effort of buying stocks. And so the way I look at it is, the Fed is not all in. They haven't. They're not doing everything they can to prop up this market. They're doing almost everything they can. They're doing a whole hell of a lot more than, certainly any of these folks would have ever imagined 2 months ago. But I'm still waiting for that final shoe to drop. I wouldn't go full, the Fed is unstoppable until they've done that, because essentially, once the Fed has conceded that they're going to buy stocks and try to prop them up, well, then the Fed can print as much money as they can, even if they're the only buyer in the market, even if they have to buy up every single stock and every single share of all these ETFs. The Fed can do that if they want to. And considering how overvalued this market, still is, by incredible leaps. In terms of market cap to GDP, we are still well above the peak of 2008's market cap to GDP. I think we're sitting somewhere around like 125% range currently, and I think that the peak in 2008 was something like 105%. And so we're nowhere near recession territory. We're still well above the last boom's territory. So I think at some point there is going to be a retest of the lows that we saw just a few weeks ago in the stock market, when I think we got just below 2,200. And from there could be potentially another leg down. You could break through there. 1,800 was the number I was looking at back then. There seems to be a lot of other people who are also leaning on that 1,800 number. And the reason I believe why I selected around 1,800 was that would be about 75% market cap to GDP, which would seem reasonable to me for a recession, let alone a depression. But I thought that is sort of a minimum low and a potential place for a sustainable bottom. By no real metric have I seen any indication that 2,200 was from a fundamental perspective, any kind of a sustainable low. And so the fundamentals are clear that we need to go lower. But like I said, the Fed is throwing so much, so much ammunition, if you will, or so much fuel on this fire, trying desperately to support the market. I think the market will try and push the Fed, to take that last step and start buying up stocks themselves. And so somewhere around that 2,200 to 1,800 range in there, if the market gets down to 2,200 and certainly above 1,800, I think the Fed is going to step in and start buying up stocks. And that, I think, will be the point to where you never want to fight the Fed again. Because at that point, the stock market will, in principle, become completely detached from reality. There will be no need for private traders to be in that market for the price to remain perpetually high and to keep going up. It will be a complete sham at that point. The Fed can target whatever level in the S&P and the Dow and the Nasdaq that they want if they are buying stocks. And so at that point, we could be, in a 10-year-long depression and have stocks going up 10% every year. But the point is, we're not there yet. So I think that Goldman's call is premature. Now, of course, the Fed actually does take this final step. I think that it might finally start waking up ordinary people. If they can see that the Fed is literally propping up the stock market and essentially giving welfare to, the richest Americans who own, most stocks, then maybe there might actually start to be some popular resentment towards the Fed. Now, it might be for the wrong reasons. It might be for, they might paint some sort of caricature of the Fed that doesn't really, fit reality, and talk about how, oh my God, capitalism is so bad. We need full communism now. But at least they'll be mad at the Fed. Now, the other alternative is that if people witness that there is this very blatant welfare for millionaires and billionaires, again, just like happened in 2008, through the Fed directly buying up stocks, well then perhaps the calls for a people's QE will reach a fever pitch, meaning that the Fed will be compelled essentially to provide Americans with some kind of a basic minimum income. And of course, if that were the case, if we were printing money and mailing people a check for $2,000 a month, well then that would be the end of the game right there, because then you would get your hyperinflation. That's what all these countries that have had big inflationary problems. The difference between them and the U.S. is that they didn't print money to buy up assets. They printed money for consumption. They printed money and handed it out to ordinary people. And so that money, made its way into normal consumer markets and led to the inflation of prices, not of assets, but of consumer prices. And that, I think, would be the final nail in the coffin, which will destabilize what little order is left in American society. But there will be plenty of time to discuss that later. So maybe I'll do that one day this week, try and go in depth into what exactly an inflationary environment looks like under a regime of people's QE. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.